So I'll be in dialogue today with Paula Campbell Roberts, a U.S. consumer economist, managing director and head of global consumer and real estate, macro and thematic investing at KKR. She works with KKR's teams, driving the firm's thematic investing efforts. She's had a number of publications recently, The New Normal, the long-term impact of COVID on cities and consumers, and her most recent report titled Consumer Trade-Offs. You've also probably seen her recently on CNBC, Closing Bell, and also the New York Stock Exchange's Floor Talk. So very happy to welcome Paula today. So there have been all sorts of reports. We heard sort of the panel about the health of the office. We've had articles about the urban doom loop and all of these other sort of prognostications, but at the end of the day, it's going to be about consumer choices, which is why I'm incredibly happy that you're here. And maybe I'll start my question just with the Fed, the elephant in the room, so to speak. So we're currently seeing a Fed-led policy shift and a rising risk of recession, as we heard from some of the people on our last panel. I'm wondering if you could just walk us through your view from the macro environment and touch on maybe different geographic regions. We've heard some things about Miami, we've heard some things about New York. I'm gonna put a little bit of money on New York, because, you know. But in this environment, are there particular asset classes that benefit? And what are some of the other things that you're seeing today?
Well, thank you, Marc, and thank you all for having me. I'm actually going to begin to answer that question by taking us up maybe 100,000 feet, right. Which is, if you think about the regime we've just exited and the one we're in right now, we were in post-GFC, a low growth, low inflation environment. And there were a number of factors that were serving to keep an anchor on inflation. Demographics were deflationary, technology, price discovery kept prices low. All of those factors were keeping inflation lower. Fast forward to COVID, where this inflation that we're talking about is driven by both cyclical and structural factors. Demographics have now turned inflationary, right? We're talking about labor shortages that are driving up wage growth. We're talking about, and this is unique for the US, in 2025, we're actually going to see an increase in working age population growth. The US is the only country where you're going to see that. The other factor is globalization, which had served to keep prices low. We've moved from globalization to deglobalization, where supply chains are regional, labor is now remaining in domestic regions. All of those forces are serving to be inflationary. So what that means, and important for real estate investors, is going forward, we should expect, even beyond sort of the cyclical forces driving inflation, we should expect higher inflation for longer.
Wow.
And for real estate, that's actually a good thing, because I agree with the last panel and with your point that given the Fed's tightening campaign, we should brace ourselves for a mild to medium recession next year. But importantly for real estate, nominal GDP is going to remain positive. We actually have not seen that in a very long time. So 2020, 2009, both inflation adjusted and nominal GDP were negative. For the first time in a long time, real GDP may be negative or flat, but nominal will be positive. So if you are a holder of real estate, you can, the value of your real estate might actually improve. You're able to reset prices. You can pass on prices to the consumer. So a holder of real estate can actually do okay. In the short term, though, given what the panel just described, higher borrowing costs and the fact that in private real estate markets, values haven't yet reset, that's a challenge, but I'd call that a 6 to 9 month challenge. Over the medium term, this is the asset class where I think there's still a lot of opportunity.
So in that sort of the paradigm that you talked about, is we maybe go into a recession, but do you see that as a recession that sort of has a bottom, or sort of stays flat and kind of we come out of it? Because in previous recessions, you have the dip.
Yes.
This seems like a very strange cycle.
It's a very strange cycle. For one, if you look at the job market, it doesn't look like anything like a recession, right? Our house call is that we certainly have a dip next year, but likely by the end of next year or early 24, the Fed starts to cut rates, and that leads to not a V-shaped rebound a la COVID, but a rebound nonetheless in 24. So we don't expect this to be a contracted downturn.
Right. And so as you're talking about maybe an increasing workforce for the US, but also all of the headwinds for office.
Yes.
That might be another headwind, right? Because if hiring remains strong, I wrote down the statistic, the 40% of jobs on LinkedIn
Yes.
that might be 100% remote might not actually help
The office market.
office market.
So I think about the office market as akin to what we've seen in retail, right? For a long time, we said retail was dead, it's never coming back. We can shop completely online. Clearly, that didn't turn out to be true. To be sure, omni-channel, buy online, pick it up in store, all of those are now mainstay concepts. And you have to have, a retail location that makes sense or is worthwhile for anyone to go in person. But to be sure, retailers, and I work with our consumer private equity teams as well-located, well-set up retail that provides a great experience is still thriving, right? And they're even adding stores. I think we're going to see the same in office, which is what some of the panelists earlier said, which is this bifurcation between Class A and Class B, the sort of live, work, play concept really surviving and thriving. The other point that I would make is, I'm friendly with the chief economist at LinkedIn, and so I'm familiar with the 40% statistic. But the other thing that their data shows is that where we're losing jobs already is actually in that remote office cohort.
Interesting.
So those jobs where those individuals are 100% remote and not going into the office at all is where we're seeing the most pressure in terms of elevated layoffs. So for that reason, while I don't think we ever go back to 100% in office, I think there is still going to be a correction in that part of the market.
All right. So this is the 55th year of this capital markets conference. So I felt compelled to talk about like the late 60s and the early 70s and if there are parallels and other things. People are also talking about that in terms of the economy, right? Because we had this starting inflationary period that got worse, and then as we proceeded became stagflation, and people are making comparisons to the situations in the 70s. This might be different, but I'm wondering, sort of is it valid to look to that history in our economy to make comparisons or predictions about how we move forward?
I personally, as an economist and a practitioner, always think it's helpful to understand what has occurred before. And in my view, there are similarities to the 1970s, but there are also important differences. And it's important to understand both. Similar to the 1970s, there are a number of factors driving inflation. So you have food crises, energy crises, policy mistakes, so monetary policy. All of that was occurring in the 1970s and is also occurring now. But one important difference that my team and I, who are in the audience, have highlighted is the role of labor. Then real average hour earnings growth was actually positive. And so it served as a multiplier effect, which is why you got to inflation levels that were 14.5%. Here, real average hourly earnings are still negative this year. We think they'll turn positive next year, but this year they're negative. And so that serves as a bit of an anchor to inflation. And we're talking about 7 or 8% inflation, not 14% or double-digit inflation. So I think that will serve to rein in inflation, and why we do believe that inflation returns back to probably 2 to 2.5% by 2024.
By 2024? Okay. And 2023 is a month away.
This is right. Still elevated in 23.
And so your work, a lot of your work really focuses on the consumer and then what the effect of that is on the markets. Consumer spending is probably around two-thirds of the US economy. So obviously it's a key driver. I'm wondering what your thoughts are on the state of consumers and maybe how that affects, we've been talking a lot about the office, but housing, right, is another big sector that's a little bit in flux, right? I mean, interest rates could have an outsized effect on affordability, but we also talk a lot about the lack of supply. So I'm wondering, sort of in the consumer space, sort of how you're thinking about
It's clearly a big topic. As you're talking, it's 2/3 of the economy, and then you throw housing in there. Different from prior cycles, we're not talking about a consumer that is over-levered or has high default risk. And I think that's important to recognize. Yeah. That said, and I think, as we were talking about the office, you also have to think about the consumer as being bifurcated. Through the COVID disruption, lower and middle income consumers were supported by fiscal stimulus. By the end of last year, that stimulus had dried up, and you really started to see pain in that part of the sector. And so through this year, while overall the consumer sector actually looks very healthy, you're seeing retail sales continue to do well. If you peel the onion and look at lower and middle income consumers, they're feeling strained. So you're seeing auto delinquencies start to tick up, credit card utilization tick up, in place of debit card utilization, right? Which is always a telltale sign. On the other hand, while all cohorts were able to increase their savings, given stimulus, given reduced economic activity, today lower and middle income cohorts don't have any savings, almost worse than they were before COVID, whereas upper and middle income cohorts actually still have a good deal of savings. So you very much still have a bifurcated consumer. I do believe, though, with the equity market volatility, we saw just until the past couple of months ago, and what will likely resume in January and February as it becomes clear that the Fed's not going to let the foot off the gas pedal, overall consumer spending will slow from here. But it really is going to reflect a choice from upper and middle income households, and then the lack of wherewithal for middle and lower income households. Mm-hmm. So that's the first part of your question. To your question about housing, I often get the question, well, is what the Fed doing even working? Well, you only need to look at the housing market to say it's working, right? And if you think about at the end of last year, mortgage rates were around 3%, and right now 7%. You've seen the difference in housing activity and home price depreciation already. And into next year, we're actually forecasting outright declines in year-over-year home price deceleration, which again you haven't seen in a very long time. And given that most households have hold wealth in homes versus the stock market, that's really going to have an impact on the psyche, and I think that will impact spending as well.
I mean, one question for me, especially around the housing issue, is while interest rates go up and might sort of dampen the frenzy, yep, it also dampens, right, the construction markets, the supply, and other things. And I wonder if those things start to even themselves out a little bit. And so we don't necessarily get the benefit that would come from decreased market demand, because we also aren't getting the supply increase. And I wonder if those things are correlated, or if you see a way to increase supply over time in this inflationary market.
It's a very good point. I would say we probably would have seen price declines that are worse than what we're seeing today had it not been from what you're describing, which is the supply-demand imbalance. Demographics, overall demand for homes is being met with a lack of supply in multifamily and single family. That has served as a floor, but the fact that we're seeing declines anyway is really showing you how strong that affordability lever is being pulled right now, right? Which is driving prices lower. To your point about supply and where we can see shifts in the near term, we've actually been studying the role of home builders recently. And whereas historically home builders represent sort of 10% of inventory that's coming online, today they represent 30 or 40%. Huh. And so if you think about the characterization of the buyer, that buyer is less emotional, is going to meet the market where it is. So as home prices start to tick down and demand starts to wane, given the weakening of an economic activity, I think that sets up actually for more inventory coming online and then further pressure downwards on home prices.
So I think the mayor, when he comes, will be happy about that statement.
As long as if you don't own a home, I guess. Yes.
Yeah, if you don't own a home. And in your report, one of the things that jumped out to me was you were saying that a lot of the growth and the things that have sort of kept us maybe out of a recession is the spending by upper income households. Mm-hmm. And maybe during the pandemic, it was more even, or because of the stimulus. Mm-hmm. But are those upper income households, do they still have the confidence? Are they still going to do the spending? Can we still depend on those upper income households to sort of maintain some of the spending in the economy?
It's a great question. What's been interesting about this year, you described it accurately. There's almost been a passing of the baton. During COVID, spending growth was driven by lower and middle income households who are benefiting from fiscal stimulus. They passed the baton to upper income households who, on the back of pent up demand, economies reopening, the desire to travel and eat out, spent a ton this year and certainly have been propelling overall income growth. Even to this day, like I mentioned earlier, retail sales have been surprising to the upside more generally. But over the next 12 months, I think that story starts to shift. One, we run out of the pent-up demand. You kind of have gotten it out of your system. Two, we do expect to see more layoffs, not as bad as the global financial crisis, but certainly in tech that we're already seeing, in finance that will likely come over the next couple of months. And then finally, sentiment for upper income households has turned sour, right? Looking at equity market volatility, looking at income expectations over the next year, I think in the most recent data, sentiment for upper income households is actually worse than that for lower and middle income households, despite the difference in wherewithal, right? So that just sets up not for necessarily negative spending growth, but just much softer next year versus this one.
Yeah. So back to the office just for a second. I'm wondering, because the last panel was talking about, and I actually agree, right? Like, go back to the office. It's where we network. It's where we have the kind of conversations we might not have over Zoom or over email. But there's some also problems larger than the office, like commutes or childcare or other things. And those things also, I think, play into some of the things that you talk about in your reports about spending and where our money's going. And I'm wondering if the office not just has to create more free snacks and lunch, but if
that helps.
But if there are larger issues that are beyond the office, right, that are more to municipal or federal policy that might help both the economy, but also help with this kind of return to work that I think many people in the industry, frankly, are banking on.
It's a complicated question, and I think itself probably has different levels, right? Certainly in the high-end office market, doing exactly what you said, which is not just treats, but making it a place where you can have a full breakfast and a full meal, where there's potentially childcare, where it's generally a pleasant place to be. And let's not forget, COVID has not gone away, so where you feel like you're in a renovated building where the HVAC systems are working, well, there's a health center on site. All of those make a difference for especially your tech, finance, those types. In Hudson Yards, I'd say we have all of that, and everyone's in the office, like the panel who we're just on is in the office 5 days a week. That helps. But more largely or more broadly, I think you're absolutely right. It is expensive to do so, right? To live close to the office, especially if your office is in Manhattan. And the commutes are costly and take a lot of time, especially if you have young ones at home. So I think that is a larger policy question to consider. How do you make it more affordable? How do you think about wages versus the cost of living, which is something that can be tackled both at the federal and government level as well as at the employer level, right? But I'd say over the long term, I'd expect those employers to win who help figure that out.
Right.
Right?
Yeah, in reading that recent New York Times article that had a lot of different quotes, right, on both sides of the issue, it was interesting, the statistic that people that work at home are actually, at least those with long commutes, are actually more productive. Right. And so I also see this sort of bifurcation in some ways between upper and lower income people with the longer or shorter commutes.
Yes.
And I wonder if we're in some ways going to have sort of differentiated job markets. We see that in academia. Students with an incredible desire to come back, staff not so much, right? Professors somewhere in the middle. And I wonder how much other sectors, if we actually don't just look at the retail sector or the office sector, but within those sectors, who is affected, who's more productive, who's less productive, if that maybe even changes the future of the office. It might change the way we finance it. Might change the way it's laid out. And if you know, at KKR, you're looking not just at sort of like the financing, but like what you're financing and how consumer preferences or consumer impediments might be affecting that.
At first start, and I'd echo what the last panel said, I think, you know, office is a challenging place, both from an acquisitions and from a lending perspective. It has to be trophy office, proven concept, and I still think it would be challenging to get done, right? So it's not a sector that we're leaning into today. But looking internally, I think you're right that even within sectors, your more established, you know, heads of firm are probably have a different perspective on coming into the office versus your newer employees, and probably a different perspective from those in between, right? Your newer employees who are just starting out, I agree with the last sentiment. I tell you all, go into the office. It's an apprenticeship game, and the only way you're going to learn from your colleagues who've been there for a while is to be in person, right? Get the cup of coffee, like I think Jeff said. Yeah. Whereas others who have perhaps established networks, who know the firm, have a little bit more flexibility because they may know all the players, so operating from home is not a loss 1 or 2 days a week. Right? And then you have others, which is a bit of a joke, who have full households at home, who are excited to leave home and get to the office so that they can have a little bit of white space in the office. So I think that will have an impact for sure, but I'm not sure that necessarily changes the footprint for a place like KKR, because we still need to accommodate all of those individuals, right?
Right. So maybe I'm going to try to create a bridge. Is it also an ESG issue? Right? Is it when you think about these issues, think about investments, think about sort of these markets. You know, ESG has grown, you know, certainly over the last 5 years as a topic, and I'm wondering sort of how that weaves in to investment decisions, to discussions in the company, and to other things.
ESG, which is what it's called now, but at KKR, we've been investing with an ESG lens for 10 years plus, right? We think about the communities in which we invest or set up properties and the like, and wanting to make sure that there is a balance and we're sort of doing right by those communities as well. So we've always had that lens of examining externalities. Fast forward to today, you also have additional interest from tenants, right, who are demanding an examination of carbon emissions and the like, or how you're treating the workforce and labor, or how you're benefiting renters, right? Those are questions that are now coming from outside in, as well as regulation in New York, in Europe, in particular, that are driving more companies to think about these things. That is a mainstay, right? So, you know, we've been thinking about this with our own framework for a long time. I think we now have to appreciate the framework of regulators and tenants and the like, but you know, no mistake, moving forward in that direction is what we'll continue to do, because we just think it's the right thing.
Yeah.
And it's also, you know, especially in our real estate business, you make money from it, right? Like it could be lower costs if you're, you know, from an emissions perspective or from the materials you use perspective. And certainly tenants are choosing buildings and are willing to pay more for buildings that are have that consideration in mind. So it makes good business sense as well.
Yeah. So what about the G part? How does the G part, the governance part, play into some of that as well?
Well, you know, there's governance in terms of procedures that we set up internally, and then certainly how we internalize what I was talking about, frameworks or regulation that's coming online. This is not something that you sort of tackle on a one-off basis, right? You have to have a framework, a sort of a board of governors per se, to understand when it makes sense to lean into some of these issues, when it really moves the needle, when it matters. And so in order to tackle the E and the S, you need to have the governance to make it make sense.
Yeah. And then maybe the last thing I'll touch on is just New York. We're sitting here in New York. And there are, especially, right, I think we're now at almost exactly 3 years since reports out of Wuhan about this virus. We're 3 years into it. It seems like it's something we're going to live with, endemic like the flu. And certainly in the first part of the pandemic, New York was at a disadvantage, right? It's dense, like all of its strengths were playing against it, right? Its density and the way people commute and all of these other things. Are you optimistic about how New York comes out of this or sort of adjusts to a new normal in this?
I'm a New Yorker, and so I always think it's a bad idea to bet against New York. So I probably take the other side of the coin versus Jeff. I actually wrote a paper on this during COVID when it seemed that everyone had left New York and San Francisco. And what we did, similar to what we talked about with inflation, is look at historically at what has happened when you've had a major pandemic like this. And surprisingly maybe or not, the same thing happened during, the Spanish flu, any of these, which is everyone escapes the city. Of course, it's a place where it's easy to transmit disease. If you don't have the right infrastructure set up, it's not a great place to be. But what came out of each of those pandemics was new infrastructure, especially on the health side. What we take for granted today was actually an output of some of these pandemics in New York, right? Or in some of our big cities. So we thought the same would happen here, right? Especially if you think about what's special about New York, which is it's a cluster of all of these different industries and peoples internationally and domestically, which are just hard to replicate. Yeah. So the way I think about it is the shift is really not anti-New York, but it's really what I call dispersion, right? 10, 15, 20 years ago, you would have thought about 2 or 3 nodes of economic activity in the US, right? Today, they're probably 10 to 15. But that doesn't mean New York is less important. It's still a place where many people start their careers or at some point pass through. Unfortunately, I think there's been a little bit of barbelling of New York, which is something I hope that we address. But I long-term am more constructive of what comes out of this, right? Which I think are going to be better, more open spaces, which we've seen in Hudson Yards and Battery Park and the like, probably more of that, better health infrastructure. And I hope, what comes more front and center is an examination of some of the issues around inequality as well. But I would never bet against New York.
Well, I highly recommend that these reports are so instructive, and it's great that they're also made public because I think they inform so many other aspects of the economy. So thank you for joining me today.
Thank you, Marc. It's been a pleasure.
Yeah.
Great to be with you.